Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with Wes Gray. How you doing today, Wes?
Great. Happy to be here, Kirk.
Good. Well, glad to finally get Wes on the show. He's just a wealth of wisdom and want to just dive right in here. But before we do, Wes, why don't you tell us a bit about your background?
Sure. I'll give you the Cliff Note version. So I am a former United States Marine, which is a unique aspect to be an asset manager. And I have a MBA and PhD from University of Chicago. Left there. I was a professor. And then simultaneously to when I started being a finance professor, I actually got cold called by a billionaire who had read my blog and read my dissertation. And kind of while I was professing, I was also getting put in business by this huge family office. That was back in 2010. And ever since then, we've just been operating an asset. I ended up leaving my professor job. I think that was 2015. So 7-8 years ago now. And we now run an asset management firm where we do manage accounts. We run ETFs. We have our own ETFs, et cetera.
So it's a good segue here. How does it compare, the academia to the practical nature of investing? Like what did you see as kind of the biggest differences?
Yeah, well, so the one thing I would say is so getting a PhD is generally a waste of time in the sense that if you want to be a practitioner and try to make money, being a PhD or having a PhD is not really a good use of time because you got to spend 4 or 5 years of your life getting hazed by professors and doing research and blowing your brains out in a back room on a computer staring at data all day. So obviously there's more efficient ways to figure out how to make money. The one thing I would say about it though is going through a PhD pipeline and doing academic research, it does force you to be a very good researcher and understand the scientific method, understand the process, where the holes are in other people's work. So I'd say that's valuable because you're always assessing research and assessing new ideas when you're being a practitioner. But, I think a lot of people would appreciate that, in the end, do you want your professor managing your money if they've never done a trade before in real life? Probably not. Maybe you want to have them help inform the process or give you some background on the research, but you definitely don't want them clicking the buttons. I would say there's definitely different skill sets there.
Nice. Well, that's good to know. I'll make sure I hire my professor to manage my money.
Yeah. And well, just to give you some stories on that, because I've always been obsessed with trading, investing, everything for a long time now, 20, 30 years. And even in the PhD program, I used to trade penny stocks. I used to be a deep value stock picker. And literally most of my contemporaries at that time, who are all now famous professors, they literally have never, still to this day, probably have never entered a stock order into Schwab or TD or anything. It's kind of crazy, the gap between a PhD finance professing how it all works, and you've never even entered a order in on the computer before. So, it's pretty funny.
So I'm curious because I hear this all the time on the news, and probably rightfully so. But people talk about how a lot of the academic models are broken or they don't work, or the traditional ones that people use. So can you talk about some of the larger ones that people rely on or that Wall Street uses that aren't even don't even function properly?
Yeah, I mean, so obviously the key thing with a model is just a model. It's not reality. It's just trying to help you understand the world that we live in, which is highly complex. And so you got to start with something, right? And the answer to a shitty model is a better model. And we're always trying to improve, right? And so it's nothing against any ideas out there, because we all got to stand on the shoulders of prior ideas. So what I'm about to say is just with all that caveat in mind, I got nothing against academic models. I think they're super useful. I would say the biggest issue I see with models, and one might be for example, the CAPM model or the mean variance analysis model, which essentially says that, hey, all we need to do to figure out an optimal portfolio is understand the expected returns on all available assets in the marketplace. We need to understand what they call the covariance matrix. And you could run it through a bunch of equations and systems, and out will pop the optimal portfolio, right? So this is like one of the most famous things that pretty much everyone learns when they become, an MBA or a master's student in finance, how the efficient frontier works and how the, mean variance analysis works. So that's a model that a lot of things are based on. And basically kind of a good example of why that is broken in particular is one of the assumptions there, and one of kind of the inputs is you got expected returns and covariance, or kind of variance on an asset. And so one of the logical conclusions of that model is that, hey, if you find a bunch of things like stocks, assets, or what have you that have positive expected return, but they have zero correlation with one another, wow, we can magically combine all those things and make infinite money, right? Because if you take a lot of things that earn positive return, but when we combine them all, because they're uncorrelated, they have, there's no risk. It looks like a risk-free asset, right? Because you have something that makes money, but it has no variability. So this is the underlying, like, oh, these pools of mortgages are essentially no risk, because if we pool all these mortgages from all these different houses, across the globe, they're basically no risk because they're positive return, but they're all uncorrelated. So what we can do is we can leverage that up, sell it as AAA, and it's all good. And of course, that's a great model. But again, models are only as good as the inputs. And one of the inputs, again, is that covariance matrix. And we all know what happened there, where the assumption that they're all uncorrelated is just not true, and the whole world blew up, right? So that's a model that a lot of people have relied on. They still rely on, but it's like anything. If you garbage into the model, you're going to get garbage out. And you see that all the time.
So, it kind of leads me to the question, as you're talking about the mortgage, crisis there that we had, whatever it was, 14 years ago. How do you, if people are looking at assets and trying to find non-correlated or low correlation assets, how do people do that in a time like this? Like, what are the ways you've seen that are actually effective?
So I would say, like, even though obviously I have like a highly quantitative background, we're a quant shop, I would say don't rely on quant, rely on common sense, right? Because the problem is whenever you look at past data, you can convince yourselves of a lot of things. And the problem with a lot of things that are quote unquote alternative or non-correlated is when you look at on average, they look uncorrelated, right? But the problem is a lot of strategies that are deemed alternative a lot of times require leverage. So for example, your, long short equity, or, global macro, or whatever the heck it is. Well, the key thing that binds most alternative strategies is leverage. And guess what happens to leverage during financial crisis? One, it gets really expensive and it evaporates. So even though you may have a bunch of strategies that are seemingly uncorrelated, because on average, like, what the heck does, long short equity have to do with like merger arbitrage, which has to do with like managed futures? Intuitively nothing, except fortunately they have one thing that binds them all together, and that's financial leverage. And that is correlated across all these strategies. So that's why a lot of people, they build their fancy hedge fund portfolios with 50 different things that all sound different and great. And then they wonder, like, well, wait a second, I'm in the middle of a hellstorm here and my hedge funds are down, 20 or 30%. Like, what's going on? Well, the problem is the assumption that they're uncorrelated is kind of true on average, but not during the time when you actually care about it. So that's a long-winded way of saying that it's really complicated, and you just want to look for things that at a common sense level, it's intuitive. For example, like stocks are just different than, say, treasury bonds, right? And maybe stocks might be very different than, I don't know, like oil futures. Like there's some things that maybe just at a high level, intuitive level, they're just different mechanically. And if there's no tie of leverage and underlying strategy, you might be able to piece together a portfolio that's, relatively well diversified without thinking too hard, is what I would say. And yeah, I mean, kind of the classic is stock, bond, real estate, commodity. Great. Yeah, you kind of hit the big muscle movements. And beyond that, you're starting to get into danger territory where you might overcomplicate and outsmart yourself, and create a portfolio that seems like it's uncorrelated, but the reality is it's probably going to blow up just like everyone else when, the world goes bad.
Yeah, it's interesting you say that, the common sense approach as a quant shop, that seems to be almost kind of counterintuitive. But looking back, like the correlations, like what we've noticed is, correlations are normal, right, the ways you expect them to be until you need them the most, which is 2008, 2020. You can go back and it's like all of a sudden everything correlates to one when you need it the most. And there's, I don't want to say there's no way to protect against that, because there are ways, but it breaks all the models. So I kind of look at this and say, well, Wall Street's filled with a bunch of smart people. Why are they not figuring this out? So do they want to figure it out, or what's the answer to that?
Yeah. So the answer is, remember, Wall Street is set up to sell people stuff, and they're not PhD researchers. So going back to our original conversation of, like, one of the benefits of going through a PhD program, getting hazed by the top researchers in the world, is you understand, how to assess data. And so what happens, like a good example is like this year, right? This year, like most people had set themselves up in like 60-40, where they're 60% stocks, 40% bonds. And they're like, well, look at, last 20, 30 years, it's been amazing, because anytime the market blows up, bonds do really well. Well, great. The problem is, you're only looking at the last 20, 30 years of data. You haven't done like good research and looked at, well, what happened in other markets? What happened over the past 100 years? What about the past 200 years prior to that? And it's in the data. It's not like a surprise, but clearly whenever there's a change from a deflationary world to where there's a potential for unexpected inflation, to be in the mix. Well, why in the heck would bonds be a good diversifier against equities if the crisis itself is unexpected inflation, i.e. what just happened, right? Well, no shit. You probably don't want to be all in on 60 stocks, 40 bonds under this assumption, just because it's quote unquote worked the last 30 years. Well, anytime my stocks go down, my bonds go up, so I'm all good. Well, not really. You're not a very good researcher or data analyst, because if you looked at a sample in live data, that's clearly not the case. That's why you have commodities. That's why you trend fall. That's why you do other things. And so the reason, like, well, why don't people trend follow more? Why don't they have more like commodity type exposures? Well, the reason is because over the last 20 years, those things sucked, right? And you can't sell things that suck in recent memory, because when the client says like, well, how's it done recently? And you're like, well, not very well. That's a bad sell. Where if you say, well, how's it done recently? And you show them like, well, here's a 60-40. It's real simple, real cheap. It keeps working. They're like, all right, that sounds good to me. And so the problem is you always have the incentives of, like Wall Street needs to sell you something. And usually the things that have worked the best recently are the best sell, but they're not necessarily the best tools or technique on a go-forward basis.
Yeah, I see a lot of portfolios of people with random stuff in there just because you can tell somebody sold them to this at some time and they're still in there and they never bothered. It's like there was no design put into this portfolio. It was just like, oh, here's a bunch of different things that look like they were probably hot at one point. Like why would you have a tech fund, a health science fund, and like, high yield, but it's like, it's totally no thought put into it. Like you.
Oh yeah. Well, to that very point, so we have an internal software tool we built to basically do due diligence on like we will deal with advisors all the time, and they'll send us their portfolio and be like, hey, tell us what you think. And it's not against them. It's just a lot of people don't have the technology or capability to understand it. But you're exactly right. You'll see a portfolio that has, okay, it has the large growth, the large value, the small growth, the small value, the utilities, the technology, the blah, blah, blah. And they'll have like 50 funds, all these stocks. And what our tool will do is it'll forensically like throw away all the wrappers and look through and reweight as a global portfolio. And we'll be like, congratulations, you just replicated the S&P 500 for 10 times the fees. Where would you like a brown, would you like your gold star for being an idiot? And what's remarkable is a lot of people don't even know that, right? Because we're usually dealing with advisors that are actually trying to do better for their client. They're not just like trying to sell them crap. And even they don't recognize that, oh, wait a second, that wholesaler seller told me that was going to be like diversifying to my portfolio. And I'm like, well, yeah, but if you put the 10 diversifying things from the wholesaler in your portfolio, you just replicated the market again. and you're back to square one. You could have bought it from Vanguard for free. And so that is a highly reoccurring theme that we also see a lot of times in just our day to day, I would say.
So that brings up the question, because obviously we're in a new paradigm right now with inflation, with high inflation taking hold, and I think there's a whole generation of people who've never seen that. For the last 20 years, it's been missing from investors. The last 40 years, bonds have gone down, and all these people with these 60-40 portfolios or bonds in there have said, hey, bonds are safe. Of course, they're not safe. They just were safe. But how do you look at this new paradigm? Like, what kind of ways would you look at investing in a time where, bonds are bad investments, stocks are bad investments, maybe commodities are okay, but how do you look at an environment like this and say, all right, other than sitting in cash, like, how do you look to make money?
Yeah. So one of the things I would say is when we are trying to build a portfolio construct for somebody, we don't take a stance on, is there going to be hyperinflation? Is there going to be deflation? It's because nobody knows and no one can predict that, right? Like, the goal is let's make sure we diversify this portfolio such that it's protected with something in all these different scenarios, right? And so going back to like the standard 60-40, well, the problem with the standard 60-40 is if you have your stock. So if the world's normal, things are rocking, the economy's good, well, you're going to win there. And then if the world goes into depression, problems are going on there, well, that's why your bonds are useful. But where is your inflation component in there? It doesn't exist, right? So does that mean that you just take the 60-40 and you throw it away? No, it just means that it doesn't have any sort of protective elements to an environment like we've entered now, where what if we do have potential for high inflation expectation? So then you want to say, okay, so obviously we need to fill this portfolio out. We want to keep our bonds because they can help in a deflation. We want to keep our stocks because they just kind of grind out and earn the risk premium. But what kind of tools can we use to at least protect against inflation? Well, I don't need to pontificate about this. We can just, again, go look at the data. There's people that study this and have looked over, all the years of data. What are the kind of asset classes and strategies that protect people during changes in inflation expectations? And it basically boils down to a class of basically trend following models, which, if no one understands what trend following is, it's pretty straightforward. You want to buy things that are winning and get out of things that haven't been winning. And so the specific strategies there would be like commodity trend following. So you can get strategies where, like, if commodities are starting to do well, they have positive returns over, say, like the last 12 months or whatever, own them. Otherwise, just go to cash. So you could have like a commodity trend strategy that does really well in inflation environments. You could also do a bond trend strategy, right? Where you have like, let's say you have like a 10 or 20-year duration bond. Instead of just owning it, buy and hold, maybe what you do is, if the trend is positive on bonds, okay, own it. If the trend is not positive or negative on bonds, you could either go flat or you could go short, right? So you could do like bond trend. So commodity trend, bond trend, those are both good strategies for inflationary environments because they allow you to kind of dynamically move with the environment as opposed to just being static. On the equity side, there's like momentum strategies. So strategies that buy stocks that have had strong recent performance, and they kind of systematically do that process. Those tend to perform really well during inflationary regimes. So those are kind of like three things that are at the top of the list, at least historically, do well. Some other ones is just, even though I personally am not a big fan of buy and hold commodities, but commodities is just a strategic hold also do well. So like holding gold just strategically. Nowadays, maybe you could hold Bitcoin, even though it obviously failed pretty miserably in the recent one. But still, the intuition for Bitcoin to be an inflation hedge, I think is still probably decently sound, because it's not like when you build a portfolio of inflation hedges, it's not like you're going to only have one thing that is going to work all the time. So you might want to put like a composite, like maybe have a little Bitcoin, maybe have some gold, maybe have some buy and hold commodities, and then maybe add some trend following like commodities or trend following bonds. These are all kind of ideas that, at least historically, have done really well as an aggregate on average through high inflation regimes, basically.
Yeah, I like the trend following approach. That certainly fits into some of your quant strategies. One thing I'll ask you about, because you mentioned gold, it's funny because I look at the 1970s and say this is kind of a mirror image of probably what we're going to experience to one degree or another. And everybody says, well, gold did really well. But, I don't just look at the data. Gold did really well for a specific reason. You weren't allowed to own it prior to that. So it was priced well below what it was worth. And so, yes, it went from 25 up to $800, but it was only because it was undervalued to begin with. It wasn't necessarily because it was a great investment. I'm not saying it wasn't, but I think people miss that kind of call it causation to some extent. But I think the question is, gold has not performed as most people would have expected in an environment like this. I know it's performed much better than Bitcoin, and maybe that's the key. Maybe gold has performed well compared to cash. But I guess the question is, if you look at stuff like that, we're in an environment that is, the 70s were confusing too. So I don't want to put it past that. But how do you come up with strategies where the environment is going to be confusing, right? I mean, we had mortgage rates go from 2% up to 6.5%. Now they're about 5.5%. Bonds, the expectation is bonds are going to go up, but of course, in January of 2023, the expectation is that yields are going to start to decline. We have not experienced inflation. Most people alive today have not experienced inflation of the 70s, so they don't know what it's all about. So I would imagine there's probably a lot of confusion there. So how do you even do a trend strategy when there's that much confusion into what's going on?
So I'll tell you what. So we internally run these systems called managed futures, and this is like way too complicated, too much crap to deal with. But I'll walk you through at the highest level, the most complex version of how to deal with this, which is probably not appropriate for 99% of people. And then I'll walk you through some DIY techniques that anyone with a Schwab account could implement successfully without a lot of brain damage, right? So in general, what a lot of people do if they have enough capital and enough bandwidth to deal with it is there's this idea of commodity you can get your hands on. Every single bond you can get your hands on, and you're going to trend fall, right? If a certain commodity like gold is moving positive, great, own it. If it's going negative, great, you short it. And you put all these things together. And in general, that's considered a super dynamic diversifier across all the regimes, right? Because if we're going inflation, great, you're going to be short bonds, long commodities. If we're going to deflation, you do the opposite. And if there's something in between, like you were mentioning, where like, hey, Bitcoin sucks, gold sucks. Well, guess what? Because their trends suck, you're not going to own a lot of them, but you're going to be short bonds and you're going to be long like a lot of like copper, a lot of other things that have been working. So that's like the most complicated way that people do this. But frankly, for most people, it's just too much brain damage. And you can accomplish a similar sort of idea pretty simply. And we have a concept we call poor man's managed futures. So for people that don't want to deal with all the complicated crap and fees and all that good stuff, you could simply take the following assets, and I'll give you some tickers and ideas how you could do it. So you take a generic commodity fund, right? You could use like PDBC if you're familiar with that. It's just a generic, kind of owns a little bit of all the commodities, right? That's your commodity sleeve. You could pick some real estate, because real estate's kind of a hybrid, right? Where it's kind of inflationary protection. It has interest rate ties to it though. So it's like an inflation deflation hybrid. You could take like V&Q, like the Vanguard REIT fund or something, right? And then you've got bonds. We like to have treasuries. So you get like, let's say 7-10-year duration treasuries. We use IEF. It's like some cheap iShares product. So there you go. You got 3 tickers right there. And there's a million options, doesn't matter. But PDBC is your commodity sleeve, V&Q is your REIT sleeve, and you got IEF is your treasury bond sleeve. All you do is, if you wanted to be real simple, you just say, you know what, I'm gonna allocate a third to each of these, but I'm only gonna put that allocation in there if the long-term trend is good. So for example, if I look at PDBC and I say, hey, the last 12-month moving average, it's positive, great, I own it. If it's not, go to cash. And I look at my REITs. Hey, are the REITs, are they positive? Great, own them. Otherwise, go to cash. Same thing on bonds. Are the bonds positive, trending? Great, own them. Otherwise, go to cash. And if you just do like a simple strategy that kind of does bonds, REITs, commodities, just do a simple brain dead trend following rule, which is, you update it once a month. That is actually, because we've done a lot of research on that very brain dead concept. It's almost like a hedge fund that like anyone could implement with a little bit of thinking. It's a great diversifier against like an equity book, and it kind of allows you to kind of dynamically move between inflation and deflation regimes. If you want to get more complicated, throw gold in there, right? You could trend follow GLD, and you could do a million permutations of that basic concept. But we know a lot of DIY people that do that. They just use ETFs and trend follow a basket of them, and they use that as their diversifier essentially.
Yeah, that's great. I appreciate the kind of the poor man's approach, because I think a lot of these things, managed futures. I mean, I know the broker dealers sell them, but they're they're a different
too
strategy.
Expensive, yes, and we run them for ultra high net worth, where you can come to us and negotiate and all that good stuff. But it's just after, if you go to the broker dealers, you pay all the big fees, you deal with all the bullshit. It's just not going to work for normal people. But you don't need it to. Like I just said, you can run like poor man's managed futures for free, once a month in your Schwab account without a lot of brain damage. Yeah, so I just recommend that for a lot of people.
But that's a great approach, and I appreciate you sharing it. One question that always comes up though is that sounds great, but when do you I don't want to say rebalance, but when do you make changes? Is it once a month? Is it once a week? Once a day?
So we actually provide free signals on like long-term trends on all these different asset classes on our site. I can give it to you at the end. It's free. You got to sign off that you're a financial professional, so you can't sue me. But because we just do it as kind of like just to help DIY people. We usually recommend like just once a month is fine. Like people like to overcomplicate that and like, let's look at it every day or every week. And we've done all the research on this. The reality is you don't want to be too fast, because now you're a day trader and you're going to get destroyed in transaction cost. But you don't want to go too slow, because if you look at the trend every 6 months on gold, well, you're going to miss it whenever it breaks or goes, whatever it is. So like, I think monthly is kind of that sweet spot where for most people, it's not onerous on them. It's not heavy transaction frictional cost, but it's dynamic and fast enough that it's going to protect you against like big shifts or movements in the marketplace over time. If you wanted to do it every 2 weeks, that's fine. If you want to do it in a month and a half, that's fine. But I think month is kind of that sweet spot for normal people to manage like a dynamic trend following portfolio if they wanted to. There's also products out there that do it, but if you just wanted to avoid all fees, like in theory, you could do it yourself too.
Yeah, no, I appreciate that. That's great that you kind of provide that. What do you typically do for signals? You looking at like moving averages, or how do you kind of look at it?
Yeah, so we look at a couple of varieties of trend. One is just impermanent price of the asset against like the 12-month moving average, or you could use 10-month moving average or 200-day. It doesn't really matter. It's just like the general class of like long-term trend, like moving average is one idea. If you wanted to do, hey, I want to do one part is 12-month, one part is 6-month, fine. Doesn't really matter as long as you're in the ballpark. The other kind of model we use is what they call like an absolute momentum model. I don't know if you're familiar with like Gary Antonacci, kind of popularized this idea. But what you do there is not a moving average. You just literally look at the return, like say the last 12-month return on an asset against cash. So, what is the return on cash? Well, it was 1%. What was the return on the stock market? It was 10. Okay. That's positive. That's positive absolute momentum. We're going to keep owning the stocks. So that one, you just literally look at like the past 12-month return against like a risk-free asset. That's another way to kind of measure generic, long-term trend. And we actually use several of these signals and just kind of do a composite. But like I said, you don't really need to get that complicated. Just pick a couple signals or even one, as long as you stick to it. You're always going to be roughly correct. It's going to protect you from like big blowups and huge shifts in the macro environment, I would say.
Nice. So I noticed you kind of have more of a value tilt, and I know for me, obviously, just I'm more of kind of a value guy. I like buying things cheap, and I think it's been out of favor, obviously, for a long time. How do you kind of look at when you're looking at models? Are you just looking at like the index to keep it simple? Do you look at the kind of growth versus value part, or how do you look at that?
Well, I wrote a whole book on it about 10 years ago called Quantitative Value. So if you're really bored and you want a nice doorstop, you could go read Quantitative Value and throw it away after you're done. But long story short, so for us, when we do value, we obviously we're quant, so we do it systematic, rules based. It's very simple. We're going to try to get to the cheapest securities in the marketplace. I'm just simplifying here. So let's say you have 1,000 stocks in the market. Let's go find the 10% cheapest based on price to earnings ratio. That's not exactly what we do, but kind of. So now you got the 100 cheapest names. And then in our approach, what we do is then, okay, amongst the 100 cheapest names, these are all dirt balls, right? The reason they're the cheapest names is because something's going on here, right? And so then what we do is we look at a variety of like different quality metrics. Like, hey, are you buying back stock? Are you paying down debt? Are you making money, et cetera, just kind of like basic fundamental analysis items where the concept is amongst the cheapest securities, we want to own the highest quality with the idea that is if you hold for a long haul and you pay the right price and you're not buying total junk, at some point fundamentals should matter and you make a return. So that's basically the genesis of what we do. It's obviously more complicated than that. In our particular approach, but really anybody, if the idea is you just want to buy cheap stocks and then at the margin try to get the cheap ones that are also high quality. Yeah.
Wait, you're saying fundamentals matter? When did that start happening again?
well, yeah. Well, that's kind of the problem. Like the last 10 years or so, these kind of approaches that are, focused on fundamentals, focused on cash flow, focused on quality. They've obviously made money because the market's been going up, but relative to go, 50 times revenue, don't make money, Ponzi scheme stocks. It's been a really rough run. That said, what's interesting, a lot of people talk about it, like we track this as well. You can kind of look historically at the spread and valuations of value stocks, which are like these cheap stocks we're talking about here that actually make money and like do stuff versus like the expensive stocks that generally don't make any money. And right now those spreads are literally at like all-time highs, right? They're in like 98, 99 percentile. So, and obviously, well, why is that? Well, they've underperformed for 10 years. So if you've had value underperforming growth for 10 years, eventually that spread's going to keep getting wider and wider and wider. And now we're at kind of like nosebleed levels. Now, does that necessarily mean that you're guaranteed that value stocks and things that do, make money are going to outperform? Not really, because it could go from 99 percentile to 99.99999 percentile. And I don't have a crystal ball. But we usually tell people, like, listen, like, to your point, at some point, gravity matters, right? Ben Graham is right in the long term. The weighing machine has to matter. Otherwise, what's the point of the stock market? So probably over the next 10 years, I would say that it's probably a better bet than not to be tilted into kind of cheap, high quality stocks versus the broad market and overvalued stuff. But, I've been saying that for 10 years and I've been wrong. So,
well, I think you're not wrong, right? It's just a question of what are you comparing yourself against, right? Are you comparing yourself against buying, tech stocks or FANG stocks, which everybody was doing with reckless abandon, and they were right. And how do you argue with price at the end of the day? But it feels uncomfortable. I'm a value guy, so it's been really uncomfortable for me. I'm not a momentum guy. I find it very challenging to do that because you're basically it's like going to the casino and saying, hey, let's see who's on a run and let's go jump into their game. To me, you know what I mean? Like that's basically what it is. And nothing wrong with that. I guess you got to go with what works, but I think the way I'm kind of looking at it is, it's the challenge is we get into this time period where everything's overvalued, and you could make the argument that even you talked about real estate being a hybrid kind of approach. it may be a hybrid, but it's really still a bond, right? I mean, you're buying based
There's
on
certainly
yield.
aspects of that for sure. 100%.
Right.
Yep.
If your mortgage goes from 2% to 7.5%, your monthly payments double. So, like, well, how does that math work? You're getting a 2% yield, and now you're getting like, and the real estate's going to drop 50% just to break even for what it was before for payments. I don't know. I find it, I guess personally, I find it really hard to square the circle where we are now compared to where we probably should be. Maybe you could talk a little bit about that from like a historical perspective, because I don't think people, and I just want to set the stage with one other piece. We're still, depending on the index, between 10 and 15% above pre-COVID highs for the equity indexes. And people are worried, oh, we lost so much money. Like, compared to what? So, like, I don't think people understand, like, just because you miss the top, like, you could still lose a lot more money. So how do you kind of look at a situation like this?
Well, so I mean, the thing is, I don't have a crystal ball. And I just learned, like, when you get a PhD, what you just learn is you don't know anything about anything. So the only thing that I can tell you is just what's baked in the data and what have we studied. You could say, well, I can go look historically, and I can actually look at the valuations of the market relative to history. And is there any way I can use that information to make me a better allocator, like to improve my portfolio outcomes? And sure enough, when you look at valuation-based timing methodologies, where you try to tactically time your market exposures based on overall market valuations, they're actually terrible. They're no better than buy and hold. And we've tortured the data a million ways sideways. A lot of researchers have. It's so intuitive, it just doesn't work, which is weird, actually. You would think that, like, even though it works at a stock selection level, it doesn't work at a macro level. So just because the market is really, really expensive relative to history, trying to use that as a way to time your portfolio is just not a lot of evidence that it can work. Ironically, the one thing that does work really well is actually momentum. So the basic rule is, if a market has strong momentum, own it, and valuations be damned. But when a market loses its momentum, get out of the way. That sort of tactical timing method, which is basically a form of trend following, has historically been done quite well. And it's especially done well in markets that have high valuation. So even though you don't want to, like, use the information about a market, like an expensive market, to tactically time, to the extent that a market is really expensive and you're a trend follower, now you're doing pretty good. Like, you definitely don't want to own the stock market, for example, right now, if you're believing this kind of idea, because it's really expensive and the trend sucks, right? However, to the extent that the trend came back in the S&P or whatever market you're investing in, even though it might be expensive, you'd probably want to own it based on, like, the history of tactical timing. So long story short, right now is a unique period because the trend actually sucks in the stock market and it's overvalued. So if someone said, hey, I'd like to tactically take some money off the table, I'd say, well, that's actually an evidence-based decision. Go for it. Can't fault you there. But to the extent the trend was back in the market, but it was overvalued, and you said, well, I'm going to take money off the table, that would be something where I'd say, well, it might be intuitive, but at least historically and from a lot of evidence on that, it's not really a great idea. It's better just be strategic buy and hold at that point. So anyways, it's complicated.
Yeah, no, I totally agree. So what do you think the biggest risks are right now for investors that they should be aware of?
Honestly, I think status quo is the biggest problem, going back to our original conversation there. Whereas just because something has worked over the last 20, 30 years, and, it seems like a God-given right that if you own a 60% S&P and 40% treasury bonds, you're going to perform like a hedge fund and make 10% a year on average. Like, that seems risky to me. And there's still a lot of people that just are way under diversified and not understanding, like, well, the US market's done great, but if you compare US markets and international markets historically, it looks like a yin and yang chart over 10-year cycles. So maybe you should globally diversify. maybe instead of just bonds, you should own other assets that can help you out in like inflationary environments. Like, I don't know if we're going to have inflation. It feels like it, but I just don't know. But I just think the biggest issue that I see with people right now is they're still stuck on stupid of what worked the last 10 or 20 years. And they're not thinking strategically, like, no, we need better diversification, more asset classes, different asset classes. Yes, they've sucked recently, but if your whole approach is just let's only buy the thing that worked the last 10 years, that's also a pretty terrible investment strategy. So, you know.
Yeah, no, I couldn't agree more, but that's how people look at it, right? They open their 401k statement. They're like, oh, what worked well last quarter? Let me invest in that.
I know. I know. The problem is, like, what I'm saying is basically evergreen advice, right? Like, keep your costs down, keep your taxes down, be well diversified against a lot of environments and hold for the long term, blah, blah, blah. But then you deal with people and then you got the people element, which is really the hardest thing and the biggest challenge of investing is just controlling your own demons and avoiding doing stupid stuff.
Well, that's the advantage of quant approaches, right? Is letting the computers do it for you, so you don't have to. You can take your emotion out of it.
Yes, as a reformed stock picker who used to be 100% discretionary, and learn the hard way. Yeah, I could say that because I don't ever even think about anything anymore, even though that's what I used to do my whole life. 100% systems based, no matter what.
Well, I think it's a good kind of segue here as we get close to wrapping it up. So where do you draw the line between quant and using common sense? Because you mentioned that earlier about people need to rely on common sense. So where do you kind of draw the line and how do you use both?
So we're weird quants in the sense that I like to focus on first principles and I kind of came out of like Ben Graham, Warren Buffett world, like, because that's just intuitive to me. So the problem with pure quants is they just look at just the data, just the back test, without ever considering like first principles of human nature and how the markets fundamentally work. And that to me is problematic. So, but what I don't have a problem with is you understand like some first principles of a marketplace that you agree with, you believe in. For example, value, right? Buying stocks really cheap that are high quality. That intuitively makes sense. It's evergreen. Like it makes sense what Ben Graham says, like the market sometimes just throws the baby out the bathwater, but in the end, cash flows matter, fundamentals matter. That's a first principle to me. Now, does that mean I want to go out there with my monkey brain on and go try to pick those individual securities correctly? No, I've tried that and I failed. So, but that doesn't mean I can't use quantitative tools to systematize the idea of I want to buy cheap, high quality firms. So for us, we like first principle ideas, but we don't like implementing them in an ad hoc discretionary way because it allows, monkey brain to creep back in. So I like to use the quantitative tools to just systemize good ideas. But we are not quants in the sense that we're just going to be like, hey, let's go throw 1 billion data points and run it through our back testing engine and whatever pops out the best chart, let's just do that. That just seems crazy to me. But there is definitely a class of quants out there that do that, and there's nothing wrong with that. That's not me. Like I'm kind of more. I just use the quant tools to prevent me from being stupid effectively. But I still like first principle ideas.
No, I really like that approach. I think that's probably the smartest way to approach it. As we kind of wrap it up here, I wish we had more time. Maybe we'll have to have you come back on because there's so many areas I want to touch on with you. But what are some final thoughts you can leave our listeners with, and maybe where can they find more about you and your shop?
Our shop is alphaarchitect.com. We're big on Twitter, at Alpha Architects, my handle. Those are probably the best place to follow us and learn more. As far as like last parting words, I would just say, and you probably know this too, and your audience does, is just know what you own and make sure you're always aware of like the cost, the taxes, and the incentives of the person selling you whatever you're about to buy. Because in general, if you could just default to Vanguard, like cheap, free is my base. Does that mean that's the only answer? Of course not. But if you just always default to that as a starting point and then only allow yourself to add complexity with proven, success or reasoning or process, you're going to save yourself from a lot of problems in life and in investing. So that's what I'd say. Just know what you own and, keep your taxes, fees, and complexity as low as possible. It just makes sure you always understand the incentives of what people are on the other side of the table are trying to deliver for you.
Nice. Well, Wes, I really appreciate you coming on the show. We're definitely gonna have you back on because I think a lot of the principles you're talking about are timeless, and I think as the economy changes in this new paradigm, people are going to need a lot more wisdom. So thanks again for coming on, Wes. Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money. All right. Well, that was a great interview with Wes Gray. Really appreciate him coming on the show. I've followed his stuff for quite a number of years. Very, very smart guy and definitely worth following. But now we get into the panel portion of the show where you have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. How you doing today?
Doing great. Doing great. How about yourself?
I'm doing well.
Good.
In
good.
gray and cloudy San Francisco.
Better than the 105 we have here in Boston. So.
Exactly.
And we also have a returning panelist here. We have Doug Heagren. Hey, Doug.
Hey, Kirk, got to get it off mute. How you doing this morning? It's good to see you. Hey, I love the background. Obviously positive. The market's just booming on your display back there. So hopefully everybody's investing on your screen, on your backdrop.
Yeah, thanks. Yeah, you can check that out on our YouTube channel. So now we get into the panel portion. So Megan, what were some of your takeaways from the interview?
First of all, I thought it was a really interesting interview. Wes is a fascinating guy, an incredibly smart guy. So I think when you hear interviews like this, it's really important to put things in context, right? Because Wes works in my world quite a bit. And what I mean by that is when you're listening to this interview, keep in mind, this is someone who has made models that a billionaire has basically built a family office around, right? And so he is in a really amazing position and a very challenging position. It's challenging because he has one client that has to be happy, but it's an amazing position because he's able to think through things and almost at times have the size of a portfolio to experiment a bit on, right? When he talked about things like poor man's futures and so on. So I thought it was really interesting hearing him talk through this because I could also see him in front of the family office, in front of his one big client, throwing these ideas out there and having fun debating them. And that's one of the blessings of that space. But I think in listening to it, I think he brings up a lot of great points in how we should think about portfolio management. You heard him talk a lot about transparency, affordability, tax considerations. And as investors, what he's really telling us is these are things that are important to his big client, and they should also be things that are important to you. And so my big takeaway for listeners was this is a good example of where having an investment policy statement is incredibly important, right? And I see Doug nodding his head. I know he does them, Kirk. I know you do them as well. But what Wes was really doing there was laying out investment philosophy and how he works within it. And as an investor, you should be laying out, even if it's on a one-pager, what your overall foundational investment philosophy is, and detail out how you are going to make investment decisions. Because if you're able to write this out, you start to create guideposts on how you are going to behave. And when I listened to Wes, what I took away from what he was saying is he knew how he was going to behave in certain marketplaces and how he was going to navigate it. And that's incredibly important, particularly when you're trying to navigate markets like we're in today.
Yeah, I think that's a great point, Megan. And it kind of brings up the fact that I think it's a good segue here because, Wes in large part is a quant investor. And, one of the major advantages of quant investing is that you basically put down your investment strategy into, a computer or some sort of algorithm that does it for you. So it takes the emotion out of the investing. So even when you want to make a stupid emotional decision, the algorithm prevents you because it does it for you. It makes those decisions. And I think in many ways, like you said, an investment policy statement does that. It just doesn't remove the emotions. It requires somebody like Megan to come in and say, hey, here's what we agreed on. You need to actually do it. Don't act like an emotional monster, right?
Completely. And, I think one of the things, is it's always good to do the investment policy statement when times are good, right? When you can be reflective. I got the impression in listening to Wes that he's very reflective of behavior and how things play out over time. And in particular, when you have that one big family office client, and I can relate to this, you do have to think through how you're presenting it. So I would do an IPS in good times about how you want to behave in challenging times to make sure that you stick to your knitting. Because this is where, strategy is great when things are all going up, but strategy is hard in these types of markets. And I think he touched on that quite a bit.
Yeah, that's a great point. And just to reiterate, I know we see this a lot when times are good, people's tolerance for risk tends to be a lot higher when they're doing, new onboarding procedures. And when times are bad, their tolerance for risk happens to be lower. So, times always shade that opinion quite a bit. So I think that's a great insight. So Doug, what about you? What are some of your takeaways from the interview?
Well, I don't think there's a lot to add to what Megan just said, because I agree completely. I think one of the biggest things about this is he's a PhD, right? He came through the academic world, which, those that get to the point of turning their career into a PhD, and he talks about the pros and cons and the usefulness and lack of usefulness of having a PhD in the reality of implementation with clients, right? And again, you joked, Kirk, you're not ready to run out and get your professor to start doing your management for you. The advantage of that world is they're able to look at things in ideals. They're able to look at data, and they typically, most PhDs are data driven. So that therefore, because of that, there's not as much emotion involved in the decisions. They're just looking at data to see what it says. And the reality is unfortunately, the majority of the world, and this has always been a problem with our industry and the regular world, right? Because our industry loves to talk terminology and loves to talk, mathematics and, science, and this will do this. And then clients go, because emotionally they tend to go back to that, a lot of that primitive reaction when things happen. So just like you said, Megan, one of the values of an IPS, I say this in financial planning, my job is to understand what you want so I can create this image of that future you. And then my job and why you're hiring me is to constantly protect that future you from the current you. And the current you is going to be all over the place, right? So, in ideals, clients will nod their head, sounds good, sounds good. Well, then what happens? Maybe times are great, right? But like he talked about 10 years of value underperforming, right? And hey, we know we want to hold these things. And as I've said before, you're not diversified unless you hate something in your portfolio. The problem with hating something in your portfolio is you're going to look at what's doing well and say, why do I keep holding this thing that's not making me money? The emotion of not making enough. Then you go into an economy where things aren't going well and things start falling. Then you get the emotion of, I want to get out. Okay. What the IPS does, or what having a strategy allows you to do, it's that building of that future you, and it allows you to come back and talk and remind the client, like, this is what we said we were going to do. And we talked about it. And I need to protect you in the future from what you're trying to decide right now. And so it's easier to say than it is to apply, because emotions will start making conversations highly irrational very quickly.
Yeah, no, I couldn't agree more. So let's talk a little bit about, quant investing. I know we didn't get into it as much as we have in the past, but, I think there's some, where does it go right and where does it go wrong? Right. Because I think we can all agree that some nice parts about it, like we talked about, removing the emotion, but, it's not perfect, right? There's no such thing as the perfect strategy, the holy grail. So Doug, what are your thoughts on quant investing? Good versus bad?
Well, I think the pro of it is that it's going to allow us to basically look at trends that I think at a macro level, us in the industry agree that, history does repeat itself to a degree, right? But there's also the other side of it where, again, regulators say we have to be very clear. History doesn't, what has occurred. The history of performance does not indicate, what you're going to see in the future, right? Because whether or not that trend, even though something has a pattern, and it's going to likely occur again under these ideal circumstances, we don't know when those ideal circumstances are going to mix, right? So it can be something where it could take, something very short term that has occurred, and we see this, and great, it's going to occur again, and therefore we're positioned for it. But it could take an incredible amount of time for something to occur again. Let's look at gold and looking at the back history of what gold happened in the 70s, like you talked about. In Kirk, you mentioned the impact of a couple different extra variables that went in there that were the reason that gold might have been so successful in the 70s versus the way it is now. And we might be looking at a trend of gold right now against what cash is doing and maybe what you could be invested in other areas. But that trend, I mean, we're talking 10, 20, 30-year cycles that could occur, whether it's bonds, whether it's gold. And so from a quantitative aspect, I think it looks at a lot of these ideals, and it looks for these things that, hey, I see this pattern. This pattern's going to now be make it an excellent reason to invest. For example, like he makes it, he simplifies it. Like, look at the last 12 months return against cash free. Hey, you know what? That's probably something that's going to allow it to, continue because there's a trend there, or find something that's the cheapest with the highest quality. But what does that mean, right? I mean, if you have certain metrics you're looking for, you're going to find those things fit. But I think in the reality of application, especially if you're doing this yourself, you don't necessarily have the data. And in many cases, I think the problem comes down to with quantitative investing is that, again, emotion comes into play and patience becomes a real issue when it comes to actually seeing the outcome that you're looking for come from any type of quantitative investment. To me, I think that's where those two things conflict.
Yeah, no, I agree. I think one thing's interesting is, there's a lot of good parts about quantitative models and investing. It certainly takes out the emotion, but I think one of the bad things that certainly, from my perspective is a drawback is that it removes the common sense, as we talked about, right? Like it removes, like if you see the market crashing, right? And let's say there's a very good reason, whatever. Let's say the war in Ukraine or whatever. Let's say there's something even worse. So you see something happening and, oh, well, my quantitative model doesn't rebalance till the end of the month. And it's like the third day of the month. Well, do you just let it run and just say, oh, maybe it'll be okay? Or do you kind of like turn the machine off and just say, all right, we need to go to cash for whatever reason? I think there is an element of common sense that needs to come in here. And I think the hard part is, where do you implement it, right? Like when do you actually when do you turn the machine off and just say, all right, I need to manually manage this? And I think there are a lot of people who actually do that. As some of the more famous hedge funds will do that. They'll have kind of like an override switch just in case, and they'll have criteria that have to be met in order to actually hit that switch. But it's I think it's important to recognize you can't just let a computer do it, because you might be missing on things that are even more important.
And I want to add on to that, Kirk, because you reminded me there's some management and research firms out there that provide research investing that say that exact same thing. It's like, in this model, you're going to only change this every quarter, right? And it's, and their idea on that is, again, they see the momentum, you see this thing occur. All right, every quarter change it. We don't get emotional. We don't switch in between. But I've also seen periods where there's been absolute fundamental economic shifts in the middle of that quarter. What do you do, right? All of a sudden you're sitting there and you say, well, I don't rebalance for another month. Well, at that point you might lose 30%, and then you rebalance into the things that have already dropped. So I think, the common sense factor is huge. And I agree with that's really critical, because he talks about the common sense when he's talking about his allocations. He talks about the common sense in terms of, looking at what things from a fundamental standpoint just are going to do better in this type of economy. And if you're rigid about not making any adjustments based on common sense, I think there's a high probability you're going to get burned in a lot of circumstances.
Yeah. So Megan, one thing that came up in the interview, and certainly is, it's kind of a hot button, especially for high net worth individuals, is trend following models. And I know Wes kind of talked about it here on the show. And what are your thoughts on trend following models? And I don't know if you have clients asking about this a lot.
Yeah, no, I thought that part of the interview was interesting. And I actually wrote it out as he walked us through his poor man future, because I was like, oh, you made it sound very easy, but it's not actually that easy. And you should be aware that that's actually a hard thing to do. I think that Wes is used to being in front of very wealthy investors, like a family office, and so is able to have these types of tilts in a portfolio to take advantage of things like momentum investing, right? I think the thing is, he even said it, you want to be buying things that are winning and sell what's not winning, but that's really hard to do. So when you get clients that, read about these different things like momentum in a portfolio, what you want to do is sort of position it appropriately in how to put it into the portfolio construction. Because at the very end of the interview, Wes talked about Vanguard and indexing, and that for a lot of people is a great default, right? And from a strategic standpoint, that might be the answer. But things like trend following models, right? Those are things that you could add in as a tactical tilt or diversifier to help in these types of marketplaces. And so whenever I've worked with, in working with these very, very large portfolios, whenever I've, had clients asking for that, the idea is, what can we tilt to 2, 3, 4% to give you exposure to that, but be aware that that is a very, very different type of investing. And trend following models, and in particular things regarding like momentum, it's very sophisticated risk management rules, right? It sounds really good when you say it fast, but momentum investing and those types of trading strategies, you're working with volatility to find opportunities, but you have to have a really strict mandate with how you work with it. So due diligence on the types of funds that you put in there that do that is incredibly important. And I can't emphasize enough, I'd rather wait to put a client in something as we go through due diligence rather than put them in something because it seems like a good idea and a quick fix for the portfolio.
Yeah, I know you mentioned that part of the interview where you talked about the poor man's managed futures. And, it's interesting because everyone's looking for the holy grail for diversification, the non-correlated assets when everything's going down. This isn't, as Doug always says, if there's something in your portfolio you don't hate, then you're not diversified. I think it's really hard to find that these days because everyone's searching for it, which means that if somebody finds it, other people find it, and then it's no longer diversified because everything kind of correlates once everyone's involved in it, or at least that's what the data suggests. So I think it's very interesting, as we kind of look for other asset classes. Managed futures can be, depending on the manager, a good diversifier, and I wonder if that remains true over time. But your point, Megan, is valid. Like, it's not always that simple to just take this and run with it. And the other question that comes up is, are these the right assumptions? Right? He mentioned four different pieces to that poor man's managed futures.
Yeah, it was a generic commodity fund. It was real estate, and it was a 10-year treasury fund. And he said, if you want to keep it simple, do a third, a third, a third.
Yeah.
So that was his sort of piece to it, but again, he's got the ability to run numbers and experiment with this stuff and really put a box around the risk. Whereas I would tell listeners today, this is probably not what you want to take on your own. I would be cautious. And he also brought up something else in the interview that I thought was incredibly important. Which is a lot of funds get a lot of press, but they tend to, about certain alt funds get a lot of press. But when you get into the alternative space, they require leverage. And he emphasized this a lot. And I think he's dead on about this. Leverage can sometimes take on a lot of unintended risks. And he talked about it getting expensive, it evaporating during crisis. And that's really important. So if you're an investor out there listening to this podcast and you have alternative funds, right? go through them and really look at where some of the unintended risks are in terms of leverage, because that's something that could really bite you really badly, during the type of market that we're in. And I think he called this market a crisis of unexpected inflation, which I liked that term, but it's where you could really get burned.
Yeah, no, I agree. Leverage is really dangerous in times like this. So Doug, what are some of your thoughts on this? I mean, as we're getting close to wrapping it up, any kind of final thoughts from you, and where can people find more about you?
Well, yeah, I think final thoughts is just be careful about any type of trend or any type of strategy working in all environments. I mean, we've talked about momentum several times. Momentum tends to do really well, especially on the most overbeat types of investments tend to do really well coming into recovery. But momentum investing also tends to break down gloriously during market recovery. So, because if you have to shorten that trend. And so I think, you have to be really careful. I mean, I like what you said, Megan. Something like this is something where you put it into a small piece, but if you're trying to do this yourself and make it the core of something, you're going to have to have tremendous patience, an incredible ability to overcome emotion, or you're just going to be best using someone else. But again, one thing about, you talked about poor man managed futures. I've seen plenty of active and smart managed futures that have failed. So, managers who have failed in this department. So I don't know how you make something like this simple. But I think, it can't, there is a benefit of using these within portfolios. I just don't think it's as simple as he makes it sound for the average person to try to do this themselves. So I think the big takeaway is this is an area where you definitely want to potentially have help with someone who can help you to guide through how these strategies can be useful, and also when to change your strategy according to these common sense scenarios. So if you want to learn more about me, just thanks, Kirk. Douglas Heagren. I'm at mergentgroup.com, MERGENT group.com. And also, again, if you have someone within 4 to 5 years that's going to be going to college, we have an organization, ProCollege Planners, that can help you find the discounts, find the right college, and help you pay for college. So if you're out there and you don't want to overpay, look us up, ProCollegePlanners.com.
Great. Thanks, Doug. Megan, final thoughts from you.
Yeah, I mean, one of the most fascinating things about listening to this interview is Wes makes it look easy, right? But he also is a PhD and has spent many years thinking through all of this type of analysis. So I think the big takeaway is, this is some of the basic fundamentals, which is what he focused on was having an investment strategy, which you can have with an IPS, that focused on transparency, affordability, systematic decision-making, and tax efficiency. And those are 4 priorities that every investor should have, and every investor should have written down how they feel about each of those items. So I think an IPS, the time spent, the 30 minutes spent building one, might be the best investment you can make in your portfolio for the long term. So I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, thanks for having me on. Doug, thanks for joining us. Thrilled you're here.
Yeah, thanks again, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.